Welcome to class students. Today, we'll be looking at a very important topic titled bookkeeping. Bookkeeping involves recording and organizing financial transactions, including sales, purchases, payments, and receipts. It is the process of keeping clear and concise record so that all financial information is easily accessible when needed. Bookkeeping deals with financial aspects of a transaction. There are various bookkeeping software to help you with recording the financial transactions, as well as there are various bookkeeping tasks which need to be dealt with, such as maintaining ledgers, handling accounts payable and receivables, payroll services, inventory services, invoice processing, investment or business advice, then prepare for tax returns. Why is bookkeeping important for business? Bookkeeping is important because it provides or make accurate budgeting possible. Bookkeeping is vital for budget creation as it provides an organized view of income and expenses, which helps businesses in making informed financial decisions. A well-planned budget acts as a roadmap for controlling costs and allocating resources in an efficient manner. Accurate bookkeeping keeps you prepared for taxes. By regularly updating financial records, bookkeeping helps businesses stay prepared for tax season. Having all the financial information easily accessible keeps the tax authorities satisfied and prevents any late-minute headache during tax filings. Maintain organized record. Regular bookkeeping ensures well-maintained and organized records. This helps in easily retrieving crucial financial information and saves businesses from stress of searching for documents during deadlines. Enables proper reporting to investors. Investors own a share in a company and are in a position to make effective decisions. They are mainly concerned about whether their money has been used properly or not. They certainly want to know if the company is making money or not. This aspect can be easily managed with bookkeeping. The profit and loss statement, which is prepared regularly, shows the profit are also and also determines the potential based on the revenue. The performance chart and various information can easily be prepared and documented. Thus, bookkeeping helps to avoid the hassle associated with reporting to investors. It aids in setting and monitoring business goals. By keeping a close eye on financial records, businesses can set realistic goals and track their processes, thus in turn foster better decision-making and faster business growth. It ensures compliance with government regulations. Government regulations often require businesses to maintain financial records. Regular booking ensures that business stay compliant and avoid any penalties or legal issues. Single and double entry bookkeeping. What's best for your business? There are two primary methods of bookkeeping. We have the single entry and double entry. Single entry bookkeeping is simple and works best for small businesses with few transactions. It involves recording transactions once after as an income or either as an income or an expense. This method can be compared to maintaining a simple checkbook. However, it does not track assets and liabilities, making it less comprehensive compared to a double entry bookkeeping. Double entry bookkeeping, on the other hand, is more sophisticated and it is generally considered the standard for businesses. It records each transaction twice, once as credit and once as debit. The system allows for more accurate and detailed record of a business financial health, including assets, liabilities, equities, income, and expenses. Difference between single entry and double entry bookkeeping. We are looking at it in terms of complexity, accuracy, qualification, balance sheet, cash flow and income statement. In terms of complexity, single entry is simpler and suitable for small business, while double entry is more complex and suitable for larger business or businesses. In terms of accuracy, sing single entry has no accurate picture of a company's health, while double entry has an accurate picture of a company's health. In terms of qualification, single entry does not require trained accountants, while double entry requires trained accountants. In terms of balance sheet, it does not provide it in terms that is in single entry, while double entry provides balance sheet. Single entry in terms of cash flow and income statement does not provide them, while double entry provides cash flow and income statement. What's the difference between bookkeeping and accounting? Bookkeepers record and organize financial transactions, while accountants deals more on analysis, that is analyzing data and preparing financial statements. Bookkeepers focus on day-to-day financial activities, while accountants take a more analytical and strategic role, interpreting financial information for decision making. Bookkeepers handles data entry of expenses, receipts, invoices, while accountants handle tax planning and compliance. Bookkeepers focus on accurate transaction recording, while accountants makes business recommendation based on financial analysis. Think of bookkeeping as gathering and organizing the ingredient, that is financial data, while accounting as using those ingredients to cook the meal, financial analysis and strategy. How to get started with bookkeeping? We have choose a bookkeeping method, either single entry or double entry. Select accounting software, organize and categorize transaction, establish a routine, seek professional help if needed. Choose a bookkeeping method. First, decide whether you will be using or you will use single entry or double entry bookkeeping. Small businesses may start with single entry, but as they grow, it's advisable to switch to double entry. Select accounting software. Today's technology offers various accounting software to simplify bookkeeping. Some of them cost less but do not offer dedicated accountant service. Others offer unnecessary extras and cost a fortune. So seek the one that is avoidable and offers dedicated and accounting services. Organize and categorize transaction. Record all transactions and categorize them appropriately. Regularly review and update this information. Then establish a routine. Develop a routine for recording and reviewing financial transactions. This could be easy daily, weekly, monthly, depending on your business size and the volume of transaction. Then seek professional help if needed. Don't hesitate to seek help from experienced accountant or bookkeeper if you find managing your financial records challenging. How to record entries in bookkeeping? We have in cash registers. Is a simple electronic device for basic transaction recording, ideal for small businesses using single entry bookkeeping. Usually, cash registers are used to record cash flows in stores. The cashier collects the cash for a sale and returns a small balance amount to the customer. Both the collected cash and the balance returned are recorded in the register as single entry cash accounts. Cash registers also store transaction receipts, so you can easily record them in your sales journal. Cash registers are commonly found in all businesses of all sizes. The journal. The book of original entry chronologically records all transactions, serving as the foundation of double entry bookkeeping. It is a place where a business chronologically records its transaction for the first time. So a journal is where the business transaction is recorded for the first time. A journal can either be physical in form of book or diary, or digital, stored as spreadsheet or data in an accounting software. It specifies the date of each transaction, the account credited or debited, and the amount involved. While the journal is not usually checked for balance at the end of the fiscal year, each journal entry affects the ledger. It's imperative that the ledger is balanced, so keeping an accurate journal is a good habit to keep. This form is useful for double entry bookkeeping. The ledger is a book or compilation of accounts. It is called the book of secondary entry. After you enter transaction in a journal, they are classified into separate accounts and then transferred into the ledger. These records are transcribed by accountants in the order assets, liabilities, equity, income, and expenses. Like the ledger, the ledger can also be physical or electronic spreadsheet. A ledger contains chart of accounts, which is a list of all the names and numbers of accounts in the ledger. The chart usually occurs in the same order of account as the transcribed record. Unlike the journal, ledgers are investigated by auditors, so they must always be balanced at the end of the fiscal year. If the total debits are more than the total credit, it is called debit balance. If the total credit outweigh the total debit, there is a credit balance. The ledger is important in double entry bookkeeping, where each transaction changes at least two sub-ledger accounts. The trial balance. Trial balance is produced from the compiled and summarized ledger entries. Compiles ledger entries to test accounting accuracy, listing all the accounts with their balances. The trial balance is like a test to see if your books are balanced. It lists the account exactly in the following order: the asset, liability, equity, income, and expenses, with the heading account balance. An accountant usually generates a trial balance to see where your business stands and how well your books are balanced. This can then be cross-checked against the ledgers and journals. Imbalances between debit and credit are easy to spot on the trial balance. It's not always an error-free, though any miscalculated or wrongly transcribed journal entry in the ledger can cause an incorrect trial balance. It's best to look out for errors early and correct them on the ledger, instead of waiting for the trial balance at the end of the fiscal year. We also have financial statement. The next and probably the most important step is in bookkeeping is to generate a financial statement. These statements are prepared by consolidating information from the entries you have recorded on a day-to-day basis. They provide insight into your company's performance over time, revealing the areas you need to improve on. That's the financial statement. It's the most important step in bookkeeping in order to generate financial statement. It generates the three key reports such as cash flow statement tracking money movement, balance sheet showing financial position, and income statement detailing revenue and expenses. The cash flow statement is exactly what the name suggests. It's a financial report that tracks incoming and outgoing cash in your businesses. It allows you and investors to understand how well your company handles debts and expenses. By summarizing this data, you can see if you are making enough cash to run a sustainable, profitable business. We also have the balance sheet. The balance sheet reports business assets, liabilities, and shareholders' equity at a given point in time. In simple words, it tells you what your business owes, and the amount invested by shareholders. The balance sheet is only a snapshot of a business financial position for a particular date. It must be compared with the balance sheet of other periods as well. The balance sheet allows you to understand the liquidity and financial structure of your business through analytics like current ratio, asset turnover ratio, inventory turnover ratio, and the debt to equity ratio. How to record entries in bookkeeping. We also have, well, we're still talking about the income statement. It's also called the profit and loss statement. Focuses on revenue gain and expenses incurred by a business over time. There are two parts in a typical income statement. The upper half lists operating income while the lower half lists expenditures. The statement tracks this over a period such as the last quarter of the fiscal year. It shows how the net revenue of your business is converted into net earnings, which results in either profit or loss. The income statement does not focus on receipts or cash details. Then the last but not the least is the bank reconciliation. Bank reconciliation is the process of finding congruence between the transaction in your bank account and transactions in your bookkeeping records. Reconciling your bank account is an imperative step, an important step in bookkeeping, because after everything else is logged, it's the last step to finding discrepancies in your books. Bank reconciliation helps you ensure there's nothing amiss when it comes to your money. Thank you for listening.